What's up, guys? Today we're talking about 5 benefits of yield farming that no one really talks about. I've made a lot of profits from yield farming. In my opinion, it's much easier to turn a profit from yield farming compared to trading, and I will explain a little bit about that throughout this whole video. If you guys are new here, my name is Richard. I'm a yield farmer and investor, and here's a quick portfolio update. My portfolio is doing pretty decently well. Mid to small cap altcoins are struggling a little bit, but Ethereum has been really strong, so the ETH profit and loss on my portfolio is kind of fluctuating a lot, but still net positive here, outperforming holding in the market. If you look at my closed position, it's still sitting at really nice profit at 8.6 Ethereum. But it's not all rainbow and sunshine, right? Recently, I did close this position for a loss, but I rotated the AI XBT I had for the syrup to ETH pool here, which is sitting in a decent amount of profit here. I just got into this pool, as you can see, and hopefully our portfolios do really well in the upcoming alt season. So let's dive into the video here, and like always, this is not financial advice. I'm just sharing what have helped me in the past. Hopefully you get some value out of it, but please do your own research and make your own investment decisions. So the first benefit of yield farming is that it increases your patience. As an investor, patience is really important. A lot of times in crypto, the entry and exit is very important. Even if you're investing in the stock market, the entry and the exit is also important as well. A lot of great investors like Warren Buffett, they basically try to find undervalued companies that are selling their stocks at a cheap price. They buy those stocks, and then over the next few years, they appreciate in value, right? In crypto, it's kind of the same. You're betting on the price increase of these crypto tokens based on either fundamentals or speculation. And in most cases, it's both the fundamentals and speculation at the same time. So the patience is really important here, especially because crypto is very volatile and there's a lot of market timing risk. One example of why you do need patience with your investment is Ethereum here. You can see in the last cycle, Ethereum went to almost $5,000. It retraced really hard, dipped below $1,000, and it took a very long time for the prices to be trading at $4,000, right? And in the last few months, people were saying Ethereum is dead. Ethereum broke support, right? It's going to $1,000 or beyond. But what we saw instead was a price swing upwards. If you're not patient, you're not going to be making very good decisions, right? You might be selling too early. You might be buying in too early. So patience is very important. And in my opinion, yield farming does give you a lot of patience because during this whole time, when we're yield farming, we're earning cash flow. And then we can use that cash flow to pay for our expenses if we want to, or to grow our portfolio into more investments, right? So I rarely feel the need to rush into the market and deploy all of my capital because my portfolio is generating a ton of cash flow and is giving me more patience. I don't need to chase the gains to make an income. A lot of traders, if they don't trade, they stop making money, right? You always need to hunt for the next play, but it's a little bit different from yield farming, where it doesn't really matter if the market is moving sideways or trending down, we're still generating cash flow. And especially if you guys are yield farming altcoins like I am, we're waiting for the altcoin season, right? Where the Bitcoin dominance dropped sharply. We saw this last cycle here in 2021. And if we measure the uptrend of Bitcoin dominance, it actually lasted 980 days. So almost 3 years of Bitcoin dominating the market before the altcoins really take off, right? We see a similar stretch here of 900 something days once again. And finally, we're starting to see the sign of altcoin season. Maybe it comes in the next few months. Who knows? I can't tell the future. But what I can tell you is that it takes a ton of patience to be investing into altcoins, especially when you see Bitcoin ripping up higher. And if you guys don't hold a ton of Bitcoin, then we could be feeling the pain of just missing out on those gains, right? But yield farming really helps with that. It gives us the cash flow we need to pay for our expenses, as well as to accumulate more altcoins or to accumulate Bitcoin. If we're trying to stack more Bitcoin, right? Yield farming is a great way to be more patient with your investment. Every great trader that I've talked to or investor, they all emphasize the importance of patience, and yield farming helps a lot with that. The second biggest benefit, in my opinion, is that we get to keep great entries. So unlike trading, a lot of times if we want to take profits, then we need to sell a little bit of our holdings, right? For example, I'm yield farming Bonk and ETH, but if I were trading this pair, if I kept buying here, I could decide to sell my positions right now for a profit. But the downside is I would miss out on the pump, right? If this token keeps moving higher, then I would not have exposure into this token. But with yield farming, you can see I entered in this green line. Maybe my capital gains is not as high as just buying and holding the token because of impermanent loss, right? As Bonk moves upward, whatever Bonk I have in the pool is getting slowly converted to Ethereum in this case. So maybe my performance won't be as good, but the benefit is I could keep my original entry and just keep milking the fees. This is what I like to do all the time. When the prices are above my entry, I just keep aggressively selling my fees. This basically de-risks my position. I take profits on the fees, and then when the token comes back down again, I could decide to compound more of my fees if I want a heavier allocation. But to take profit, we could choose to exit the position completely, or we can just choose to take profits on the fees. That's a great way to keep the whole exposure if you're still bullish on this investment, right? We don't have to go chase new investments all the time if we don't want to. If you guys look at this Bonk and ETH pool here, you can see there's roughly 1.23 ETH worth of capital gains right now. And then on top of that, I'm making like 60 to 80% APR on my capital just sitting in this pool. And then I could just keep taking my profits, right? I would actually secure more than my initial investment, assuming that Bonk and Ethereum still does really well in the next 1 to 2 years. So really that gives us a huge edge in the market. We don't have to sell out of our positions that we got in for cheap. We could just ride the wave upward and keep taking profits. The third benefit of yield farming is that we can take more risk without being wiped out. So what I mean by this is that we have our core liquidity pool position, right? A lot of times these are the assets that we're planning to hold for a very long time. For example, it could be Ethereum to USDC, Ethereum to Sol, or Ethereum to Bitcoin. Those are going to generate the fees, right? And then what I can do with these fees is to use it to invest into higher risk altcoin LPs that are generating more fees and have the chance of appreciating in value by quite a lot, right? And this is how we could grow our portfolio really quickly because even if this altcoin LP goes to zero, right? It goes to zero. It doesn't matter because our original core positions that are not likely to go to zero are still going to be printing fees. And then we could just take another whack at all LPs once again, right? Once we have built up a good amount of fees. But of course, when we're betting on the different altcoins, we definitely don't want these pools to decline, right? But it's a great way to take on more risk for higher return without actually risking your original positions. If you guys are not yield farming, it's very hard to have this type of setup where you could just keep swinging and keep taking risks month after month. And this is how I've been able to start from just 1 to 2 liquidity pools like Pixel to ETH into more liquidity pools like Ethereum to USDC, Bonk to Ethereum, Pendle to ETH, Syrup to ETH, and so on and so forth, right? I'm able to generate thousands of dollars every single month that I could then use to spawn new LPs, and that would grow my portfolio really quickly. Which leads me to the next point. Compound growth on your portfolio could be really great, especially if you guys are yield farming. I personally like to use this Dave Ramsey compound interest calculator. It's very simple and easy to use. Let's say I want to invest in the crypto market for the next 15 years. It's actually not that long if you guys think about it. A lot of times, traditional finance investment, you're looking like 20 to 30 years in the future, or even 40 to 50 years. So 15 years of compounded growth is not a long time. Let's say I have $200,000 right now, which is my current portfolio. And let's just say I don't add any active income to my portfolio, which I haven't done this year at all. My portfolio is already growing at a great pace. So I don't really need to spend too much money to add into my portfolio if I don't want to. And let's just say my return per year is roughly 30%, but minus inflation of 5%. then the real return is 25%. Real return meaning that this number is in today's dollar, right? Inflation is already factored in. So this is in today's dollars. In 15 years, just by earning a 25% return per year on my portfolio would grow my portfolio to 5 million something dollars, right? And I think 25% ROI per year on your portfolio is very reasonable, especially if you factor in stuff like capital appreciation. If you guys are yield farming crypto to crypto pairs and the market moves upward, we could see the gains much more than 25%, right? For example, the low of last year, my portfolio actually went down to roughly $60,000. And then now, because I've accumulated profit, I let compounding do its work. I take profits aggressively. I diversify my investment. Now my portfolio is near 200K. So it's not really unreasonable to lock in like 25% return per year at all. If I sold all of my assets right now, I've actually made like roughly 200% return on my initial capital. So 25% is very achievable. And again, over a long time span, our portfolio would grow really, really quickly. And compounded growth doesn't mean that you're compounding all of your assets into like high risk liquidity pools, right? It could mean like we're dollar cost averaging Bitcoin with the cash flow. And then if Bitcoin grows by 25% per year on average, then we could grow our portfolio to this amount as well. So it's very achievable. And I think compound growth is much more amplified with yield farming because instead of holding in the market, for example, some of these pools here like Bonk and ETH is pulling like 70% APR based on the HODL value, right? Especially if the altcoin market 2x from this current price, which is entirely possible if you guys look at the others market cap right now, which is mainly mid and small cap altcoin. During the last peak, we were seeing like 440 billion near the previous cycle high. So if this doubles to like 560 billion and I'm still earning at least 60% APR on my HODL value, this pool value would be like $40,000 by then. And I'm still earning like a ton of money, right? That's what I call yield on cost. If you guys look at like my cost basis and US dollar value, you could see when I deposited in April 4th, the pool was worth like $10,000 roughly. And because Ethereum and Bonk has both moved up in price, I'm actually earning like higher than 100% APR on my capital, right? So again, 25% per year is very achievable, especially if we are consistently taking profits and then redeploying our capital when the prices are cheap. And lastly, there's just more room for error. When we're yield farming, a lot of times I still want to try my best to get the best entry possible and then try to exit when the market is strong. But sometimes it's not always possible, right? We make mistakes, or if we're unlucky, the token is just not trading as strong as we would like. Our thesis was wrong. So it doesn't really go right all the time. But what I really want to show you guys is this arrow to ETH position. You can see I actually closed this position for some really nice profit. If you guys look at the log here, I put in 3.0844 ETH. And then when I withdrew, it was worth 3.31, right? And I've also earned some fees in the meantime. I didn't compound 100% of my fees into the pool. But you can see when I first started, the prices are actually not the best entry. And then I compounded my fees and then I exited right above my entry. So let me show you guys on the chart here. So this is arrow to Ethereum. So arrow is being priced in Ethereum terms. What I did was I entered back here at this 0.00034 mark. It was far from the best entry. I thought that the token would be stronger than it is, but things didn't go my way, right? But a really great strategy is when the prices are cheap, I compound more of the fees aggressively. And what it does is it actually drags down my entry a little bit. When it swings back up the first time, I didn't take profit because I'm still betting that it's going to go up to the zone of resistance. When it swings back down, I decide to compound more of my fees again. And then the second time it comes around, I decided to close my position because I needed extra collateral to back a leveraged position that I was yield farming with. But the main point is that I didn't really get a good entry. My exit was just barely better than my entry, right? But because I made fees during this whole period, I decided to compound at a great time, which is typically when the prices are cheap. I'm able to close for a nice profit here, 0.516 ETH of profit on a 3 ETH initial investment. So roughly 15 to 20% return, not too bad. And if we just keep stacking small returns over time, our portfolio would grow, right? The return doesn't have to be crazy on all pools. For example, sometimes we do lose money. On this position, I lost 30 something percent, but because I'm rotating into a new position, it's making some of the returns back as we speak. And some positions are sitting in really nice profit here at near 50% ROI. But that's the idea. We don't need to have the perfect entry and exit. Again, I still want to enter near like a zone of support if I can. I definitely don't want to enter here when the prices are very expensive, unless my plan is to basically dollar cost average down if the price retrace, then entering here would not be a big deal. As long as I could make sure that the price would trend up and then trade at an average price above my entry, then my chance of pulling a profit is much higher. And again, because if you round trip your bags, it doesn't matter either. You're earning a ton of fees in the process. You're going to be in a profit versus just buying and holding. If I just bought and hold in this zone of support, then I would not make any profit at all if the token keeps retracing, right? And one thing to realize about yield farming as well is that it's not always going to be profitable. I just showed you guys a position I closed for a loss to rotate into another position that is doing really well right now. It's very similar to trading in that not every single play is going to be profitable. It's all good as long as you make a net profit over a long period of time. That's our goal here, to make money over a long period of time. Let's say out of like 50 different positions that we're yield farming with, if 30 to 40 of them are profitable and the profit is enough to offset the loss, then it's a very great way to make a lot of money in this market. So I hope that makes sense, guys. And just a quick recap here. The first benefit of yield farming is that you will have more patience because you're making money in the process, right? It's not like buying and holding where we're going long periods of time without any cash flow or without any profits if we don't sell out of our positions. And the second benefit is that we never really have to sell out of our positions if we don't want to. As long as the tokens are still being traded, we're still going to be making exchange fees. And this is particularly true for like blue chip assets. We could keep our great entries and just keep earning fees throughout the whole process. There's much less of a need to time the market perfectly. The third benefit is we could take more risks because I earn a lot of fees. I could use those fees to chase like higher risk investment if I want to, or to yield farm more altcoin pools that are higher risk, but higher return in the process. Because even if those positions get wiped out, my whole portfolio is still protected because I'm just using the fees. The fourth is compounded growth. We saw that the compound growth could be very profitable over a long period of time. And then lastly, there's more room for error. Again, we don't have to time the market perfectly. We still want to get in at a good entry if we can, but if we don't, that's not a big deal. We could compound down, drag down our entry, and then when the price swings back up again, if we want to exit for a profit, we can choose to do so. So that's pretty much it for this video, guys. If you found that helpful, then be sure to check out my other videos on yield farming and investing. I try my best to give you guys the most value with each of these videos. Thank you once again for watching. I'll catch you guys next time.